Previously on Big Matty Money.
You gotta open up that RRSP, kid. Time is of the essence. Mommy and daddy ain't gonna do it for you. Oh, who am I? Just call me RRSP. What's that stand for? Registered Retirement Son of a... I'm making that sound. Welcome back. In this video, we're going to be talking about the RRSP, part 2. If you could please first just give a little thumb wrestle to the like button, a nice massage to the subscribe button for me, and also tickle the bell notification icon. I'd really appreciate it. Thank you very much. Let's get on with the video. In this video, we continue our explanation of the RRSP, or the Registered Retirement Savings Plan. Before we head into some new territory, or province, a little Canadian joke in there for you.
Shit joke, eh?
Let's do a brief recap of what we learned so far. The RRSP, or Registered Retirement Savings Plan, is a tax-deferred investment account in which you will pay tax on it later. In it, you can buy and hold investments and not treat it like a savings account. Making contributions now allows you to defer some of the tax you would otherwise be paying now and send it to the older, less attractive yet still handsome version of yourself. And then the idea is at that time you'll be in a lower tax bracket and then you will pay less on that taxable income later in life. Now, there is no age requirement to open one, but you might want to wait till a time when you're working substantially so you have enough income to tax defer. You might want to wait until you're at least working full time. You can contribute up to 18% of your earned income up to a limit. Please check My CRA or your Notice of Assessment to see your personal contribution room. You have 60 days into a new year to make contributions for the previous year. Now, it may be a good idea to contribute to your TFSA first and try to max that out and also build up an emergency savings before you dump a whole lot of money into an RRSP, because the idea is that you're not going to be able to touch that for a very long time. What you want is you want to have some cash, some liquid cash that you can still do things with. Because if you pull that money out, you will be taxed on it. So think about your personal situation and whether it makes sense to contribute or to wait a little bit. Now, there are, however, some exceptions where you can touch that RRSP money a little earlier and get your hands all on that money, you greedy, greedy mother. One method is with the home buyers plan. Now, this is for first-time home buyers. You can take out up to $35,000 as of this recording, and you will not be withheld tax taken out of your RRSP. This money is replaced within a 15-year period, which means you can pay 1/15 of that $35,000 balance over the next 15 years. Now, 1/15, you're talking about $2,333, and so on for the next 15 years. This has to be paid back starting the second year after you withdrew the funds. For example, withdraw in 2021, you start paying back in 2023. For me, I withdrew $25,000. That was the limit at the time. And 1/15 of that is being paid through the year. So $1,666, that's 6666, is added to my RRSPs every single year. You can also take advantage of the Lifelong Learning Plan, or LLP. You can withdraw up to $20,000, but $10,000 per calendar year, and your RRSP issuer will not withhold tax. It must be to finance full-time education for either you, your spouse, or a common law partner. Now, this money will need to be replaced within a 10-year period, so you can make 1/10 payments a year. For example, if you take out the full $20,000 each year for 10 years, you can make $2,000 payments. To determine when you have to start repaying your LLP, To determine when you have to start paying back your LLP withdrawals, you can go to the Government of Canada site, and there is a chart that you can look at. I'll drop it in the description below. Now, there also exists something called a spousal RRSP. Now, I set this up for my wife and I, and you can set this up between you and your partner. This is to ensure that retirement income can be evenly split amongst the two of you. And what's happening is one partner is contributing to the RRSP of the other partner. The contributor receives the short-term tax benefit, and the person receiving it has to report it on their tax return. Now, the reason I opened this is because I was making more money than my wife, and I had more money in my RRSP than my wife had, so I contribute to hers. And I'm trying to grow hers to match the size of mine. It's win-win because I'll get the tax credit, she'll receive a retirement income that matches mine. It's also a great way to remind your spouse that you make more money than them, and hopefully they're not bigger and tougher than you, and they're going to kick your ass. So how does an RRSP work when you take the money out? Well, it's important to note that you do not get contribution room back once you pull it out. You get the advantage of the tax deduction once. Now, let's say you've gone through your whole life, you never touched the RRSP, it grew, it compounded. It's time to start taking it as your income. Now, the last day of the year, December 31st, of when you turn 71, your RRSP matures. Your RRSP matures, it doesn't have any more acne, it doesn't wet the bed anymore, it's all grown up. At this point, you'll be forced to choose between three options. Let's see what's behind door number one.
All right, behind door number one, we have lump sum withdrawal.
That's just give me all the money at once. That's it, just give me the cash. Well, if you do this, you'll be subject to withholding tax immediately. That could be as much as 30% that your financial institution is going to hold. And the entirety of what you pulled out will be added to your taxable income. So the idea is to drip it out. Now, this is tough because people at this age, sometimes they have this money and they want to gift it to their kids, they want to gift it to their grandkids, and sometimes they feel like their money is locked up. You got to think of it like this is money for you. This is your salary to be paid to you during your non-working years. Now, hopefully at this point you have other money saved up, such as in tax-free savings account, just in a savings account itself. Now, this is money that you can touch tax-free. That money you can gift in larger sums. You can take vacations with, you can get a new nose, whatever it is you got to do. But the RRSP, in order to not be taxed horrifically, you would need to drip it out. Otherwise, a lot of that money is going to go to the tax man, so see what makes sense for you.
Next up, behind door number two, we have a RRIF.
Now, in the year after you establish a RRIF, you will receive a predetermined amount of money that is based on a formula that you'll receive each year. Now, it has to do with the amount of money that you have in your RRIF versus how old you are and how much will be given to you as the years go on. Now, these minimum withdrawals are included in your taxable income, but it is not subject to withholding tax. Important to note, you can also start rocking a RRIF at 55. But you would have to see if that makes sense for you, because once you convert to a RRIF, you can't unconvert. And there's a chance that you could deplete your money as you're getting older. You run the risk of having more life than money. So that's something you have to be aware of.
And finally, behind door number three, you can purchase an annuity. That's so hard to say.
An annuity. That's kind of hard to say. I don't know why I said it like a cow. An annuity. You can purchase an annuity, which is guaranteed income for life for a specified period. Withholding tax is not applied on amounts used to purchase an annuity. Note that with all these options, you still have to pay tax because this will still be treated as your income at the time when you take it out. Even though we're saying tax deferred, you're pushing it to a year when you'll still receive it as income and it'll be taxable income within that year. As a final note, think about what works for you. There's a trade-off between locking up money for retirement that can compound and at the same time being able to have money today so that you can either purchase a home or pay for school and pay off debt. Personally, I put a little into my RRSP, a little into my wife's RRSP to kind of balance out that $0 tax owing at the end of the year. But I don't really lock up too much money, so I have that flexibility with the cash. So there's the trade-off between contributing, but also having the flexibility of liquid cash as you go through life. But that's just my thinking. Think about your own personal strategy. Thank you for toughing it out through this very dry material. Feels like it's been a long time. You're probably retired by now.
Oh, hello there, folks. I'm sure at this point I would need to explain what's going on here. Look, Everything you've watched in this video up until now was pre-recorded 30 years ago. This creature that stands before you is the real Big Matty Money live here in the flesh. This is my true form, for you see, I didn't invest in RRSPs. I didn't take care of myself. And now look, I couldn't afford the surgery. I can't afford anything. And I'm hideous. So let this be a word of warning to you out there. Think about your future self. Think about your retirement. Take care of yourself. If only it weren't too late for me. Sorry. Oh God. Here's a tissue. Why are you still watching?
We also have our free tool called Whoop Assets. The link is in the description, so open up a can of Whoop Assets.